We start off with big breaking news on the banks. Just moments ago, the Fed giving the okay for buybacks, and we are already starting to get banks announcing their plans. Let's get straight to Leslie Picker with all the details. Leslie.
Hey, Melissa. In an unprecedented second stress test this year, the Fed said it will allow banks to resume buying back stock with limitations after they were prevented from doing so earlier this year. JPMorgan has already said its board has authorized a $30 billion buyback program to begin in the first quarter of next year, and that stock popping on the news. Share repurchases made up about 70% of the industry's capital payout to shareholders pre-COVID, but the largest U.S. banks voluntarily suspended buybacks in March as the pandemic-induced shutdowns that roiled the economy and the financial markets. The Fed then said in June that all banks subjected to its stress tests were required to halt their buyback programs and cap their dividend payouts. Now, today, the Fed said that banks could restart share repurchases, expanding similar limitations already in place with dividends. These amounts are based on a formula that's essentially tied to the last year of the bank's income. Now, these rules will be in place through the first quarter of 2021. The Fed notes they may be extended after that. Under the stress test, all 33 banks maintained enough of a cushion for their minimum risk-based capital requirements levels that will not reset at this time, according to the Fed. Mel.
Leslie, thank you. Leslie Picker with the latest on the stress test here in the after-hour session. It's not just JPMorgan with that massive $30 billion share repurchase plan announcement, but also the KRE, the regional bank ETF, that's popping 3%. The XLF, the broader financials ETF on the S&P 500, that's up by more than 3%. Karen Feinerman, this is probably largely expected for a bank like a JPMorgan, and yet we are seeing that big pronounced move in the after hours.
I actually wasn't really expecting it right now, to be honest. So it's nice that, maybe I just missed it. I should have known to expect it. I'm a little bit surprised that it didn't come a little bit later. So $30 billion, that's huge. That's, 8+% of the market cap of JPMorgan. I'm a little bit surprised that they did this now because I don't think we have fully past maybe we passed the worst of COVID. I certainly hope we have, but I think there's still more damage to come. I think we, haven't seen the end of forbearance and what that will look like. And so I don't know, it feels just maybe a tad premature. What would be the downside if they kind of just hung on to excess capital and built it up? I understand it's not great for your ROE and whatnot, but so I'm a little bit surprised. I'm happy. It was just earlier than I thought. I'm happy to be, fairly exposed to the bank stocks. Good for them. I'm also a little bit surprised that they're allowing buybacks over dividend. They are still allowed to pay dividends, but over an increase of the dividend, because maintaining the dividend for bank shareholders or even increasing it is a really important thing. I think even more important than buybacks. But doesn't matter if it was surprising to me. It's still very good news.
Taken at face value, though, this is surely a vote of confidence in how well capitalized the banks are and how big those cushions are, Tim Seymour. I mean, the Fed is going to, subject these banks to very rigorous tests. They've got enough capital. It seems like a big green light for investors who also believe, by the way, that this is a big reopening play.
I think it's not only a big green light. It's kind of bizarre on the same week where the Fed gave you a very dour outlook for the dynamics of the economy, isn't it? It just they don't make sense. They don't fit on the same page, and the Fed is the godfather for these banks here. Look, no change in capital requirements. I think this is very important. I think banks which were outperforming as the yield curve steepened, we were getting some sense on the reopening trade, and banks were certainly starting to reaccelerate. I think this means banks have a lot more room to go. And I think the banks and the money center banks, at least I would focus on Citi and Bank of America, but I focus first on Citi. I think they're going to be the ones that have the outsized moves. Now, banks like JPMorgan, as they were having record earnings, they were also putting aside an enormous amount on loan provisions. And I think the reserve roll-offs are powerful. And again, this is part of where I think the buybacks will be also powerful. Forget, they had record capital markets and underwriting and FIC trading. And I just, look, as someone that's long banks like Karen, I think this is very important news for the direction of these stocks.
Sure.
And the messages are mixed to me.
A big 2021 event could also be the release of those excess reserves back into the system. And that certainly would be a good thing for bank investors. We should note the headline that just crossed at the bottom of your screen. Goldman Sachs also announcing that it will resume share buybacks next year. It did not specify the amount, but again, Goldman Sachs to resume its share buyback program next year. We're seeing that stock move higher by about 5%. We should note also that Wells Fargo also falls into the category of the 33 banks that were approved to resume buybacks. Remember that it had been sort of put in the penalty box, but it does fall into this category where profitability has been existent for 4 quarters, so it's able to do this. Brian Kelly, in terms of the banks, what do you make of this?
Yeah, obviously it surprised the market, but I think in the big picture, it's probably not that surprising because the pandemic threw the biggest real-time stress test at the bank, bigger than any government regulator could have imagined, and they survived. So I think in that sense, it's very positive for the U.S. financial system, obviously very positive for banks. But if you're at home now and you're saying, okay, what's next for the banks? It's exactly what you just mentioned. It's the roll-off of the reserves. And there's going to be this interplay between whether or not we get a stimulus package that would mitigate some of the potential losses these banks may have. If we don't get a stimulus package, then maybe those lost reserves aren't big enough. So that's really where the next crux of the bank trade comes from me. And I think in general, this is just a positive move. And as long as you don't get an economy that goes much, much deeper into weakness, then the banks should be fine.
Karen, your bank position is fairly large. So are you hedging that position? I mean, I'm just trying to understand if you are worried that we haven't seen the worst of the credit losses because we just haven't seen the worst of the pandemic or the impact on the economy, then how do you protect that bank trade?
So I think that the banks being at such a discount to the market and they haven't recovered anywhere nearly as much as so many other industries. I think that was already reflected in the prices that they were trading. This is sort of a procedural issue about when would they be able to do buybacks. I just think it would have been more conservative for the Fed to say you have to wait. So I know if Sheila Bair were here tonight, she'd be not
mortified.
Happy with this. Yes. Why not wait? Why not wait till they actually reverse reserves, right? Till they let those reserves out. So that part I don't really get. As Brian said, I don't think it changes the story materially. I'd be curious. Did a lot of people expect this already? If they did, why are the stocks up so much?
Yeah,
That's it. $4 or $5 is a big move for JPMorgan.
Yeah, Tim.
I don't think the market expected this at all, and I'm surprised to hear it. I agree with Karen. I mean, why do you have to do this now? And again, I just I heard a Fed this week that was pointing out the risks to the economy, right? And Steve Leisman came on our show last night to point out some of the dynamics there. Look, as banks have at times in the May, June rallies and rotation, we said there's something not right. Banks are either telling the story of Main Street, they're not telling the story of Wall Street. We don't really understand. This divergence is ominous in many cases. But I think really what it's telling you is that banks have some ways to rally.
They have other businesses. I mean, as we were highlighting that the disconnect between Wall Street and Main Street, banks' thriving businesses have been those of Wall Street businesses, the trade, as you highlighted, Tim, the trading businesses. And that's where they really made the deal-making business. That's where they really made their money this year, Brian Kelly. So doesn't it make sense that maybe the banks are in a position now, if they've already got the capital reserves stored up, to resume the share buybacks? And maybe that's why dividend increases are not part of it, because dividend increases are permanent. Share buybacks can be started and stopped.
Yeah, I think that's a fair point, and I think it really just does go to the health of the banks. My view on the roll-off reserves is there is probably if I'm looking at where the odds are, there's probably higher odds that banks have over-reserved. And the market will also look through that, right? Even if it looks like it's trending in one direction, I think the market will look through and look to Q3 and Q4 of 2021 and say, all right, we're going to have this blip sometime in Q1 2021. But then once we get everybody inoculated, the reopening trade, you won't have to worry about that. And the reserves will roll off. and that'll be another catalyst for the banks. And just by the way, you won't have to worry necessarily about a yield curve steepening much more. The banks can still make money. They can buy back shares, and releasing those reserves would be good for their equity.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.